With 2020 almost upon us, what should we expect from the markets? Well, joining us now is Hussain Mehdi from HSBC Global Asset Management. Good to talk to you. Thanks indeed for your time today as we look out towards next year. As your outlook suggests, it's an age of uncertainty. I mean, that says a lot about what we've experienced so far. The markets have done so well. But what is your message for 2020?
Well, I think, as you say, age of uncertainty. It's been particularly elevated this year. A number of reasons for that. Trade tensions bubbling away in the background, US-China being the main concern. In Europe, we've still got Brexit issues unresolved. Despite some near-term clarity, I think in the medium term there's going to be uncertainty heading into the end of next year. Elections in 2019 have been numerous in G20, record number of elections across major developed markets, and also recession concerns as a result of that uncertainty kind of weighing on markets and resulting in a pickup in volatility across the board.
What about the performance of the year so far? I mean, what does that tell us? What should we take through into 2020?
Yeah, I mean, it's been, despite all this uncertainty we allude to, it's been a brilliant year for market returns. So equities in particular have been standout. The US has outperformed, especially in the tech sector. EMs have lagged, but still, a very positive year there. And fixed income, again, not as good as equity performance, but still very positive. Alternatives as well have done really well. So if you're looking at multi-asset portfolio, 60-40 traditional portfolio, that's notched up gains of above 15% for the year. So market performance, excellent. Uncertainty still elevated. And I guess the natural question is, why has that been the case? And I think there's a number of reasons. I think the number one reason for us, the main reason for this positive performance, has been the policy background.
Right. So,
15 central banks have cut interest rates this year. The Fed have eased policy. The ECB have restarted bond buying. And this policy shift, this pivot to looser policy, has supported risk appetite, has suppressed discount rates, which obviously supports risky asset valuations. So this has been, for us, the crucial shift that has supported market performance this year.
One question I want to pull out from this is that, going back to the chart showing why equities have done so well, in any other sort of environment where you've got, as you say, central banks cutting, you've got all this liquidity being pumped into the market. I mean, that shows, from a central bank point of view, that the economics globally very fragile. And in that environment, one wouldn't necessarily expect to see equity markets so elevated. How much of the equity market performance is by the very dint of the fact there is nowhere better to put your money?
Yeah, I mean, that's a really good point. I mean, central banks have eased policy, not just because of the uncertainty. There has been a material downturn in the global economic growth. But I think we would say a few things about that. I mean, the market expectation, as well as economist expectations about where the global economy is positioned at the moment, do seem to be far more pessimistic than what the reality is showing us. We have something called a nowcast, which tracks economic activity across all the big regions of the world. Actually, it's certainly weakened, but it's nowhere near, recessionary territory, certainly at the global level. So this idea that, the global economy is heading towards a recession, I think is not really justified by what we're seeing in terms of the data. So, looking ahead to 2020, we're kind of expecting the growth scenario to remain pretty steady, slow and steady growth. Low inflation crucially allows central banks to continue to remain, supportive of monetary conditions. And, on the corporate profit side as well, we've had a bit of a weak year, very disappointing performance. But we really think there is scope for an improvement in corporate profitability in 2020 as well. So we're looking at a scenario of single-digit profit growth, which again can support, equity market performance next year as well.
Going back to the chart here showing these yields on the 10-year, you do very well to remind us of the fact that Germany's been negative.
Yeah.
But you've only got to look at the direction of yields. Is that going to persist into 2020, or do you think that the central banks, through policy, have arrested that decline?
I think that's a really important question. I mean, we have seen a couple of years now of really strong bond market performance. And bonds have acted as a brilliant hedge against equity market risks during that period. Our view is this rally has possibly gone a bit too far. So we are seeing kind of downside risks to bond markets, both from a valuation perspective, but also this idea that policy making globally is increasingly shifting to a more kind of fiscal dominance of keeping growth supported. So I think the risks are certainly now for us on the downside. And as a consequence, in terms of diversifiers in our multi-asset portfolios, we are looking at alternative forms of safety. So we're thinking about liquid alternatives or even style factors such as quality equities.
How liquid are you talking about in terms of alternatives?
Well,
cash is the ultimate. You're not presumably suggesting cash.
We're not suggesting cash. We're suggesting products such as managed futures, for example, as a decent diversifier. I think traditional bonds are for us risky at this point.
So what are the implications then for the investment themes going into the back end?
Yeah, so I think the idea we have is uncertainty is not going to go away. I mean, the political environment is still quite difficult. Trade tensions are certainly maybe not as bad as they were 6 months ago, but still definitely there. But crucially, we're thinking you shouldn't go defensive. It was a costly strategy to do so at the beginning of 2019, as we've seen in the market performance. So fundamentally, we remain pro-risk, and we think it's a good idea to take carry in selected markets. So we're thinking EM and European equities, Asia high yield in the fixed income space. These types of markets which offer very decent valuations, we are looking at. But I think at the same time, we realise that this kind of elevated uncertainty is likely to cap the upside in terms of market performance going into next year. So overall, pro-risk, but I think a realisation that this year's market performance was particularly good and probably quite difficult to repeat next year.
Yeah, well, I had to see. Okay, look, it's a pleasure talking to you. Thanks indeed for your time.
Thank you very much.
It's much appreciated, Hussain, and good to talk to you. Hussain Mehdi from HSBC Global Asset Management.